But now we're going to get into the fun stuff. And the fun stuff really comes as a result of our quarterly magazine, Bank Director. If you read it, you'll be familiar with a certain section that we've in the past called our analyst forum. And what we've done is we've asked leading research directors, institutional investors, private equity guys, to give us their thoughts on the market, what they see happening now, what they think might happen in the future. And one of the people that's been maybe most instrumental in both setting this up and providing information to us is our first speaker today. And as Fred Cannon finishes his water and starts making his way up towards the stage, I'm going to just let you know that Fred runs the research department at KBW. KBW as a firm has a rich history of supporting the financial sector. They're a great corporate partner of ours. We've bounced so many ideas off of each other that when it came time to look at this particular program, I was talking to their CEO and I said, I'd like to start the program with a look at what franchise value is today and how you can think about it, and it doesn't have to be in monetary terms. And he looked at me and he said, well, then I don't want to go and do that. I think we should have Fred come and do this. And so we quickly got on the phone, and Fred was gracious to say, yes, I'd love to come down. So what we're going to do is turn everything over to him, let him lead us through this whole concept of franchise value. We should have some time for questions at the end. And if you wouldn't mind welcoming Fred Cannon to the stage.
Thanks, Al. Great, thanks, Al. Al also said when he called, he said New Orleans and Jazz Fest, so that was another reason it was a bit of a tease to get me here, because actually this is a pretty challenging topic for a Wall Street analyst, because it's one of these loose things. What is franchise value? And as I like to say about Wall Street is that if it works on a spreadsheet, it will work with Wall Street. If it doesn't work on a spreadsheet, it tends not to work with Wall Street. And so how do you put franchise value in kind of monetary terms? I also know it's a hard topic for board directors of banks. One of the first banks I covered when I was out in California, it was about a 800 million asset bank, and they had laid off their CEO, and they'd put out an 8K that said, he went on his way because we're going in a new strategic direction. So I went down to meet with the board, and there was I think about 7 or 8 of them were there, and they were all sitting in front of me, and my associate and I were sitting there quizzing them. And I said, okay, it says here that you guys have a new strategic direction. Could you explain that strategy to me? And they looked at each other. Pregnant pause. Then one guy goes, make more money. And then the guy goes next, yeah, make more money. And then another, yeah, make more money. So that was the strategy, which was kind of fun because I wrote that up in my note and it didn't go over too well, so I had to actually come up with a strategy. But I also know that this kind of gets to the point that building franchise value is something that is, we know what it is when we see it, but when we're in the process of it or trying to lay it out beforehand is very challenging. But I do think it is measurable. I just put together a little equation here, because I think when we look at banks, we can see it in the valuations, and it is something that, while it can be intangible, it is something that we see as measurable over time, and it is also something that we can see in the marketplace. So really, I just put together this, franchise value is what the business creates over an extended period of time, and that's really what builds shareholder value. Which is, I think, the primary goal of most boards of directors. And that is, can the franchise create an ROE that's above the cost of capital over an extended period of time? That's really what the franchise value is. And then, can you get a market premium because the market views, and everybody, your customers, your clients, your employees view, the opportunity to grow and expand your business. So really, the combination of that is what creates franchise value and actually is what really does create shareholder value over time. Now, these are long-term measures, however, and we all know that we can build a franchise in the short term that may not be sustainable. But if you look today in the marketplace, and what I did here was I basically took the banks with $10 to $50 billion in assets and plot them on ROE, or return on tangible equity, versus price to tangible book. And that's really just the simple idea that valuation in the marketplace on book value is going to be determined by what kind of return on book value you can get. And traditionally for banks, this is a pretty sharp relationship over time, the relationship between the premium you get in the market and the return on the profitability that you can earn. Now, and most banks will follow along that. Obviously, that's the first part of the equation. Can you earn more than your cost of equity and get yourself nicely along this up to the upper right-hand part of this line? But then you can also see key banks that can actually push above that line, and that's that market premium that I'm talking about. And I think if you know some of these banks, you know that they really have, and I use the larger banks because I think they're well known, they really have created some a market premium because of the franchise value that they've been created. We look at Silicon Valley Bank, which is essentially a chokehold on tech lending because they developed a way to essentially bank intellectual property, which isn't easy for a traditional loan officer to figure out because there's no collateral and there's not a lot of cash flow. But they were able to crack that nut, and essentially they've been able to essentially create a franchise around them that gets a premium in the marketplace, and they really own that. You look at First Republic, again, another bank that has a unique customer experience that's been able to grow quickly and organically, as was talked about before, and others. And you can see each one of these has somewhat of a unique business model. I was asking my analysts about Western Alliance. I'm not positive about Western Alliance because they have been a fast grower. But since Richard Sarver also owns the Phoenix Suns, I figure he knows something about franchise value. So he figured something out along that category. But here, there's also some things that, as an analyst that don't really create shareholder value or create franchise value. And that is that a brand, which is really what the franchise is not a logo. One of the first things I did, I used to work for Golden State Bank, which was the holding company for California Federal Bank out in California before we sold to Citi. And I was doing investor relations at the time, and we had to come up with a logo for the holding company. The operating company was Cal Fed, and they had a logo and the whole thing. But we had an operating company. We'd just become public. So I figured out, okay, well, I'll go out and hire somebody to do a logo for me. So I got bids back, and the bids ranged from $10,000 to $50,000 to design a simple logo for my holding company. So I was thinking didn't really want to pay that. So I was reading the newspaper, and I don't know if everybody knows this, but does everybody know how much was paid for the Nike brand? Well, I was reading the paper that, in fact, Phil Knight went over, when he was developing Nike, went over to the University of Oregon Art Department and paid $35 to have somebody design the Nike logo. Basically, I think he just paid for the materials. So I basically came up and I asked my wife if she knew any artists, so we found somebody. We paid a couple $100 to design a logo for us. But the point here is that it's not the logo itself, it's really the brand behind the symbol that is critical. And also, brand value and franchise value aren't stable over time, as you can see some of these logos here. Sometimes in certain time periods, that brand has brought tremendous value, shareholder value, franchise value. And at other times, obviously, whether it's Enron or others, they can fall apart relatively quickly. So maintaining franchise value is something every company needs to focus on almost constantly in order to achieve the goals of franchise and building shareholder value. So when we look at it at KBW, when we look at the banks that we cover, and we cover a lot, I think we're up to about 235 banks currently with you having to research. We cover essentially every bank with more than $2.5 billion in assets in the United States, and about half the banks with $1 billion to $2.5 that are public, and quite a few even in somewhat smaller banks. But so what is it? I was asking some of my staff, what is it that really creates franchise value? And I'd say a few things. First of all, it's contextual. What creates franchise value at one point in time does not necessarily create franchise value at another point in time. We all know back in the 1990s when Hugh McCall was marching across the country planting flags in every state, he created a heck of a franchise. I sold my San Francisco bank. I was at San Francisco Bank of America when we sold to him, and that was a great franchise. That was creating a lot of franchise value over time, and now we see these major U.S. commercial consumer banks, Wells Fargo and Bank of America, that strategy did work. That strategy, I would argue today, is no longer really relevant, and banks trying to achieve that strategy, kind of planting flags in place, is not nearly as efficient in order to achieve that. It takes focus. I mean, this quote from the chairman of Barclays is important in today's environment, that the universal banking model is dead. And remember back in the 90s, that was the whole push, that the big banks wanted to be everything to every customer in terms of financial. And that essentially is drying up today. So it really does take focus, and especially smaller institutions, that focus is especially important. Because one of the things that I always take back in terms of when companies are coming to us and talking about raising capital, the combination of being a small firm and being complicated is not a winning combination, especially when you talk to investors. Small and complicated doesn't really work. Small and focused works extremely well in this environment. And also, I just put this across because there's a lot of times that people are being pitched these days, I think, especially in banking, to try to use all that retail space to sell other things, to try and do something else with it, especially when you have a branch network, which I'll talk about in a minute. But really, when we look at it, a lot of those innovations are interesting, but as analysts, we've never seen those cross-selling things, especially when you get out of your core business, actually grow deposits or grow loans. So we hear a lot of pitches, but rarely does it actually create franchise or brand value. This is the contextual issue that I mentioned. I want to spend a few minutes on that because I think it's very important. This is what we call the long-term cycle in U.S. banking, regulatory cycle. And think about this as a 50, 60-year type of cycle rather than a 10 or 15-year type of cycle. And really, the industry has always gone from kind of a regulatory, deregulatory circle in time. And it's interesting that if you think about this, that financial crisis kind of happens at 3 o'clock. And that certainly happened. If you think about 3 o'clock being the financial crisis and about 6 o'clock being where we are today, I think that's about where we are in the evolution of banking in the U.S. and really in the globe. As a result of the financial crisis, following the great consolidation of the industry that occurred, because remember, we still have the most concentrated banking industry in the United States that we've ever had, given the size of the biggest institutions. We clearly have gone through a period of regulation of fees and franchise and a decline in profitability. If you look at profitability today, the ROE for the industry has been about 11 to 13% consistently for the last 3 years, and has little likelihood of changing much from that level. Excuse me. And now what we're going from the period of what we call the great consolidation in banking to what I would call today the great fragmentation of banking. What we're seeing on a global basis increasingly is that consolidation is breaking apart. We saw GE do it just the past week. We see Royal Bank of Scotland, RBS, do it with the breaking up. ING's doing it. We're increasingly seeing a fragmentation of the banks. And that's because the regulation is, as we know, heaviest on the biggest banks. And they're finding over time that it's too difficult to do many of those businesses, so they're spinning them out. Citibank is breaking into all kinds of pieces, selling. They've sold, in the last 2 years, they've sold off 33 businesses and bought 2. And that's what's going on at the biggest banks today. And that's really the opportunity, I think, in many ways, and the positioning that the smaller banking institutions have today to take advantage of that great fragmentation. And that's really what I was getting at in terms of building franchise value. At one point in time during the 1990s and early 2000s, building franchise value in a period of consolidation was really, in many ways, building up your branch network and having a guy pay you 2.5 times book for it. That built some franchise value. Today, it's a completely different environment. It's trying to figure out organic growth, how to position the banks to take advantage of the fragmentation that is likely going to be going on for at least another decade in global banking. And the nice thing is, today, big isn't beautiful anymore in banking. Despite the competition I know we all feel from some of the better-run big banks, I would put Wells Fargo in that. And it's kind of interesting thinking about logos that here Wells Fargo is the best valued bank in the world today, and is arguably the one bank that isn't going to fragment, and is doing a very good job from almost every measurement and value in the marketplace. And their logo's a Stagecoach. I mean, come on, what kind of logo is that for modern banking? At any rate, so really today there's a tremendous opportunity that we believe SMID stands for small and mid-cap banks, that's Wall Street parlance because we care about market capitalization, really have a lot of advantages in the marketplace. And so really I think that's a key issue as we think about franchise value today. The smaller institutions really do have an opportunity because of this pressure on the largest institutions. Also, however, the biggest challenge, I think, is that a branch is no longer a franchise in many ways. And that's because the economics of a branch today are not what they historically have been because of regulation of fees and because of low rates. This is just some math that we do in terms of looking at the returns on standalone branches. We look at a $50 million asset, $50 million branch bank, and looking at it in 2006 when rates were what they were then, when you got about 167 basis point ROA in our view. Today, with current rates at the very depressed levels that we have, basically almost break even because of the deposits. And even in a higher rate environment, it's unlikely that we'll ever see the value of the branch itself at those levels in terms of the deposit base. Now, branches are a key part of a franchise. I'm not going to say that. However, a branch alone, just sitting there gathering deposits, no longer is really what creates a franchise for a banking institution. And you can see this in takeout values. This has the takeout values of banks purchased, going back in time. And in the on the top, it's price to book. On the left, I guess it's left, it is price to earnings. And on the right, it is core deposit premium. And you can see what's happened. On a price-to-earnings basis, banks are being valued today in acquisitions as high as they've ever been. On a core deposit premium basis, they've never been lower. And so I think this is a key issue, is that the deposit base, which is key to clients, is not necessarily key to the value created today. And so really, it's the earnings drivers that are key. Now, if you believe that rates are going to start moving up rapidly and the branches are going to be very valuable in a short period of time, great. However, when we look globally at a time period when the U.S. interest rates, despite their depressed levels today, are the highest in the world of sustainable economies, we have to recognize that I think that strategically, the plan has to be to keep plan on rates being low, position yourself to benefit if they go up, but plan on rates continuing to be at pretty depressed levels for an extended period of time. Al was talking about shadow banking, and that clearly is a case where indeed we're starting to see all kinds of non-banks come after banks in terms of the opportunities and profits. There was a conference in New York 2 weeks ago called Lend It that had all these P2P lenders and all the fintech that Al was talking about. They had 2,000 people come, including investors, come for a 2-day conference. Now, at KBW, if we could get 2,000 people to come to our community bank conference in June, we would be in absolute heaven. They have a conference, and we've had that conference established for about 15 years. These guys start 2 years ago, and suddenly they got thousands of people coming. That's how interested Wall Street is today in this area, in this greater area of fintech. There's money flowing into it. We can see these P2P lenders, which we can all have discussions about sustainability, but they're trading at multiples of revenue, not earnings, not book, of revenue, because they're not making any money, of course. And there's a rush, essentially a gold rush into that space today on Wall Street. And this is something that has to be, and as I think Al said, has to be worked with. Now, Al used the term shadow banking. At KBW, we ban that term because we'd like to be the investment bankers to some of those companies, and shadow banking has a certain pejorative term to it. So what we like to call them is challenger banking. These institutions, whether they're small and mid-sized banks or they're non-banks, they're challenging the larger institutions for market share, and they're taking advantage of what I term the great fragmentation of the banking industry. And that really is why there's so much interest in them today. And I think they better pick up on my term, otherwise they're going to get regulated like crazy. So, challenger banks. But I do think one of the things that Al mentioned, which I think is important, is that the number of banks is declining, especially smaller institutions. And we do believe that creates some scarcity value. In other words, at the end of the day, per my previous cartoon, the banking system is still where the money is and has to be in terms of the payment system. And it's trying to speed up and get pieces of that business, but at the core of it, money is in banks. And I think the challenge is to make sure that the value added by some of these new technologies and these new ways to approach clients can be achieved by the institutions themselves. And we look at some of the banks that are doing this, like Bank of the Internet, which we cover out in California, a branchless bank, and they're trading at huge multiples on earnings too. So you don't have to be a P2P lender, or you don't have to be some kind of non-bank to achieve value today in the marketplace and achieve that interest from the outside. What is key is adapting technology and innovation, as you're going to be talking about this conference, to make sure that you can incorporate these activities into the franchise that you're building. And this is the other thing that's very interesting, I think, today. I think we all know that the number of banks is falling, but why it's falling is also important. Why it's falling is that there's been no new banks in the United States. There's been, I think, well known, there's been 2 new bank charters since the financial crisis, really. And I know Al and I talked one time, I wrote a note, are there too few banks in America? Which I actually think there's an argument to be made for that when you look across the landscape of the United States today, in many ways, while we still have 6,000 banks in the United States, in many ways compared to what the dynamic nature of U.S. banking, which was historically fragmented, and I believe which was critical to the growth of the United States, when you had innovation in small banks across the landscape, finding ways to fund local entrepreneurs and businesses, that is really a key backbone to the U.S. financial system. We lost or stepped back on that during the financial crisis, during the Great Consolidation, as I called it, but now we're starting to see that. And one of the things, again, I think a bank charter is a scarce commodity today, but using that bank charter, I think today has a greater ability, unless you're going to sell your bank, than it ever has in order to grow a franchise. Now, technology is obviously driving bank identity today, and I do think this is the great turnover. I'm using that term a little bit too much. Turnover that we've seen, and that is that the number of paper transactions began to fall significantly in the early 2000s, but the number of branches in the United States continued to climb until 2 years ago. And so really, there's little doubt today that in most likelihood, per some of the pictures that Al was showing before, that we're an over-branched economy today. We're not necessarily an over-banked economy today. So those are 2 different things to keep in mind, the number of banks versus the number of branches. Because clearly, the kind of technology that we've been putting in place, whether it's cash management tools, whether it's mobile banking, allows there to be less of a footprint needed for your clients. However, the innovation of small institutions continues to be a key element. So we do expect these trends to continue to fall over time. And indeed, maybe branches are in a permanent decline in terms of the United States. And this is the trend that we've seen because we still have so many branches. But again, we don't have nearly as many banks as we think about that. But so really the trick with branches today is driving technology to drive more customers per that footprint that each bank has. And whether that's a commercial footprint with loan production offices, or it's a branch footprint for deposits, it's really driving that technology. And you can see that you would have thought that technology would have driven more clients per branch for the last 2 decades. But in fact, it's really just beginning to take off in the last few years. But this is an accelerating change that we're seeing across the banking landscape in terms of technology and the adaptation. The good news, in my view, is that big companies don't really have an advantage. There's not economies of scale to most of the technologies that we're talking about. And in fact, part of the reason that we're going through this fragmentation of the biggest banks is the legacy systems they have, the legacy technology systems that are going to become increasingly unwieldy to those large institutions and drive down profitability over time. I mean, most of you know, I used to be with Bank of America back through 98. And you go in today to Bank of America branch, and when you pick up your deposit slip, you still check off which state you opened your initial account in. Well, why is that even relevant? It's relevant because the big companies have to use all these middleware type of systems to link all their clients together. And it's cumbersome and it's going to be expensive. So we're starting to see some technology overtake that. Smaller institutions can adopt this. It's a little bit like the issue of cell phones bypassing landlines in many developing countries. And that kind of technology is allowing those type of changes. So I thought I would close back with this slide. Because at the end of the day, we do believe that franchise value is what creates economic value, that it's difficult to measure. I tried to put up a measurement of it, but we do know when we see it that we can put a value on it and get a premium on it. Increasingly today, when we look at banks, and I talk to my analysts about this all the time, is that bank investors and bank analysts are value investors. We like to see something that's cheap and undervalued. And so we have a real challenge looking at some of these growth type of banks. Silicon Valley banks in particular is one. It trades at 18 or 20 times earnings at a big price to book. But in this environment today, remember, building franchise value is contextual. Growth is what is getting paid for and getting the premium. Now, we all know in banking that ultimately that what created shareholder value and franchise value in 2008 was great credit quality. And ultimately, as I always say, the lesson I learned in the financial crisis is you want to own the banks when they're making the bad loans. You got to sell them when they have to start collecting them. So we all recognize the cyclical nature of banking. We also have to recognize that today is really a period of when investors and the investing public are looking for growth and innovation. And so really building franchise value, which you're going to talk about today, is really about that. And I think up next, I know you have Avenue Bank, which, from our standpoint, it's been one of those companies that's really been able to create a franchise, and we believe is going to create a lot of value over time. So again, I think in terms of building franchise value, it's not so much being able to quantify it each time, but you see it, you know it, and develop a strategy around it. You'll all be very, very successful. So with that, thank you for listening.
Thank you, Fred. So before I let you off, getting out of the hot lights right here, you've got a minute. I mean, I've got one question for you. And you were talking about how we'll trade emails and we'll talk about various things. One of the reports that really sticks out in my mind that you've authored looks at the declining number of branches, but how do you replace the brand and the brand loyalty that those branches seem to convey? You have this branch network that historically has really shown a strong market presence. And as people start to scale it back, is there a substitute that you see that banks should be thinking about today?
I think that's the difference between a branch and a bank. A brand and a branch. And I think it's important to think of that difference. Because historically, as Al and I were talking about, it was really that branch network, the billboard on the sign, the logo out front, knowing that you could walk into that branch and feel good about where your money was, it created that franchise value. Today, it's really about a brand. So what does that mean? That means investing in technology outreach to your clients. It means investing in your people, because at the end of the day, today, it's more about what defines that franchise value is going to be the customer service and the technology service the individual client gets rather than that branch itself. And that takes some money, though.
Yeah, it does. So again, we're going to thank Fred for his remarks.